All right, you made it to the final segment of Lowcountry Money Talk here today. We are talking about, we're talking about taxes.
And
really.
food.
And food.
Marshmallows.
Taxes and marshmallows, they go together. Actually, we found out today that they really do go together because this marshmallow study has led us into the importance of delayed gratification. So we're unpacking that for you. Well, you're really unpacking that for us. Phil with Revolutionary Financial Group has been unpacking that for us, and we're going to finish it up today here by really talking about the difference between a traditional IRA 401k and a Roth 401k, how these work and where the taxes are coming from and when.
And it's not too late.
And it's not, that's a good message.
That's the main thing.
Yeah.
So the first thing I want to talk is I'm going to go back to the 3 buckets. We had a show where we had the buckets and we went over that. So when you're taking distributions, depending on which bucket you take money from, it's taxed at a different amount. So one bucket may be a capital gains bucket. Maybe I'm paying up to 20%. I'm losing up to 20% of those dollars, so that's worth 80 cents. The regular income bucket, that's going to be your traditional IRA, your traditional 401k. Now, Congress may change all of these buckets.
Right.
They can. They're trying to raise capital gains taxes. They're trying to taxes on unrealized capital gains, which I've never heard of before. But also we have the tax-free bucket.
Right.
So we want to get from the regular income deferred bucket, which is in the middle, and we want to get as much money as we can to the tax-free bucket. Because once we pay the taxes on that middle bucket and move it over to the end bucket, then we don't have to worry about what Congress is doing with all it.
We're done.
We locked our taxes
debt.
in.
Right.
Right. And we'll put up a slide here in a minute and I'll show you the differences between today's tax rates and what they were before the current tax cut. Now remember, in the sunset, we go back to where we were. Right. And that starts in 2026 if Congress is do what they do well, which is nothing.
Right.
Then the tax, and then you're going to be taxed at much higher levels.
Okay.
And they may even change it from there. So if I'm a retiree, one of the biggest threats to your retirement is taxes owed on these pre-tax accounts. Right. Because we ate the marshmallow.
We did. Okay. We waited to pay later.
I'm going to show you how to lose the weight from that marshmallow though. Okay. So here's what we do. We've got a couple of really good things going for us now. I would say good things, but the market's down. That's a bad thing. Okay. But we need to make lemonade from the lemons.
Yes.
Right?
Okay.
So we're down 10, 20% our investment account. So if we lock in the taxes now, when the market rebounds and we have those stocks transferred over or the equities transferred over into the tax-free bucket, we paid taxes on something that's down 10 to 20%. So when it goes up 20, 30, 40%, we don't have to pay any more taxes.
You always know what to do.
Because we already did that. Now the second thing is we know what tax structure we're under now.
Yes.
I just put it up on the screen here.
Right.
So if I move it over, I know exactly how much I'm going to lose to taxation today.
Right.
How much are we going to lose 10 years from now?
No idea.
No idea. So let's deal with what we have in front of us. So what we want to do, we'll get with our accountants, our CPAs, and whoever. We'll run some scenarios to see, hey, this is what we're going to need to set aside in taxes if we do this and that. And then we get the plan together, we take care of the marshmallow problem, and we move forward. The last thing we want to do for a government that has this unquenching desire to spend all of our money is let them to decide how much they want to take out of our life savings. So let's take control of those reins. Right. And let's do something about it today. And you know, the difference between the pre-tax and the post-tax is I'm contributing, is I don't defer the taxes. I go ahead and pay the taxes now if I'm still working. I get the contribution of my employer still. Now their part is going to be taxable, but your part is going to be the biggest part won't be. Right. And so we want to get these things that they're not going to be taxed at a future rate that is going to be sky high. Right. That's just such a smart way of thinking about it and looking at it, and might as well take care of it while the market's down and your taxes are going to be lower. So how does this translate to your taxes, your specific taxes? What you can do if you want to have
Phil and his team take a look at your specific portfolio is you can have a free revolutionary IRA and distribution assessment. So your team actually is going to be able to tell our viewers how much they would save on taxes by switching over to Revolutionary Financial Group. And you got to have $500,000 or more in investable assets. And if you do, this is a fully free service for them to take a look and tell you what you would save. So call Rachel and please watch our show again next time. It's been a fun time here on Lowcountry Money Talk. Thanks, Phil.
You're welcome.
And thank you.